Hi everyone, this is Keith from Investment Modes again. And today we are going to go through some index performance data, which is a request from one of my Telegram group members. He is interested to find out like what's the performance difference between if we had the opportunity to invest in a global small cap value index versus a US small cap value index. Now, today's episode is more on returns, and if you're looking for something more personal finance, this probably is not for you. But from what I understand, most people are quite interested in returns. So this might be something up the alley for you. And why the focus on small cap value? This is because I think there's a lot of empirical research that shows that if you invest in smaller equity company, a portfolio of smaller equity companies, that is cheaper, right? Historical results show that the compounded returns tends to be pretty good, such that I think what's important is that if we normalize all the all the stuff, right, it does show that if you invest in cheaper and smaller companies, there is a certain premium. Like you get premium means that you take more risk, but you are the history shows that you're compensated for the risk, and that is what is important. And because it's considered a factor, it means that this kind of observation is not just in one region, and it's not just over one time period, but it's across the board. So why global versus US? I think what he's looking for is that if he has the opportunity to invest in both, should he invest in global or just focus on the US? And I think a lot of times it's because perhaps the international equity scene wasn't doing so as well as the US. So this becomes a consideration. Okay, so why are returns important? This one seems to be like a stupid question, but basically it's like if you look at the typical financial goals, you want to accumulate to something, and you may want to spend it down, right? You probably need high returns. You probably need a high returns here. That's something that you can stomach. That you can take within your risk capacity, which means that you won't get phased out when the volatility increase. But probably less when you're spending now, because it's not just about the returns. It's like I say in my video about the safe withdrawal rate. It's also about the income that you spend from the portfolio relative to the value of the portfolio itself. Okay. Now, the issue with this topic is that he's looking for, I think, small cap value, but turns out that I don't have a small cap value index in my disposal. But I do come across this dimensional index, this research index. Research index basically means that they have this kind of like systematic investing methodology that they, and it, let's say for example, if they if they take time travel back in the past and then invest this way, how would the performance like? So that's the research index. And we do have this dimensional targeted value index, and with that, right, we can actually compare how's the performance for few different regions. So this is what I have in mind. He wants to compare, I think, US versus world small cap value. I don't have that, but we do have dimensional research index that is US targeted, Europe targeted, as well as global targeted. So this isn't exactly small cap, but it's more like small cap and mid cap companies. And nowadays the small cap companies are quite big. It's not It's not the size of your Singapore average Singapore listed companies. Singapore listed companies I think closer to micro cap. If you consider, a lot of us are using the SaaS product from the software as a service product from these US small cap companies. So they are quite large. They are like about at least $5 billion or $9 billion. That's the size that we're talking about. But of course, there are smaller ones. And this index itself is the universe, right? Let's say this index, US targeted value is small cap and mid cap. The rest of it is also small cap and mid cap. And what we want to do is that we want to maybe have a reference to see how they actually perform against a generic index. So I put them the performance against this MSCI World Index. So MSCI World is global developed. I think it's large cap developed. I did not put here. So quite different. You're comparing against large cap against small cap and mid cap. But that's probably something that you'll be able to see. A lot of people are by default they will invest in the IWDA, which is iShares, MSCI World ETF by itself. So this one will let you see, like in the past, right, how is the performance versus these three. And I think I'm not sure like why do we compare US versus global, because in the global allocation probably a large part of it is the US, and the rest of it probably makes our international typically, right, we're talking about Europe and Japan. While the Japan data is like it doesn't have such a long data, not long enough as we want to show today. But I thought it's quite good that we put against Europe. I think Europe for this period, the last 10 years, hasn't been doing well. So it adds some color into what we want to see. And with this, right, you'll be able to see like, okay, how does US stack up against Europe, which probably is a large component of the international. And unfortunately, we don't have Japan to see that. So the targeted value index, research index, right? Basically, what Dimensional wants to do is that they want to select the cheapest, I think, X percentage of small cap and mid cap stocks, right? In their universe. So in this case, it's like about 50% of the smaller companies. So you can imagine you have this one list of companies. They want to select the cheapest one. And out of these, right, they want to exclude the lowest profit stocks in terms of profitability in the small cap universe, and exclude the companies with the highest asset growth in the small cap universe. So why do they exclude the lowest profitability and the highest asset growth? This is because the empirical research shows that if you include these stocks, right, like these low probability stocks, they tend to be the weaker companies, or not just weaker companies, but if you exclude them, right, exclude them individually, the lowest profitability and those with the highest asset growth, right, performance tends to be better. And so they feel confident enough to actually put it into their system itself. And for these three data, we probably have about 40.5 years, starting from 1982. And we're going to look at some rolling returns data, right? Basically, it's like we want to see like over the time in different time frames, right? How well they do. Okay, but here is how the returns stack up. If let's say we compare 1982 from the indexes from 1982 to 2023, so that's about 40.5 years. And on the right side, we need to, it's not just about the returns, but also like how volatile it is. And volatility is not just it's not a bad word. If your stocks are supposed to go higher, right, that's also a positive volatility. That is something that what you want. But I think what a lot of people cannot feels not so good about feeling is actually when there are indexes or the ETFs or unit trust that they invest in goes down. That's negative volatility. So you can take a look at the performance. These, if we're talking about the mid cap and the small cap, that is cheaper and actually like higher in profitability, that is not containing all these high asset growth as well as low property companies, they tend to do better. Okay, like 9.6%. 9.6% over this 40 years period is not bad already, but this is like monster. It's like 14%. Probably a closer comparison is comparing the MSCI World Index against the Dimensional Global Targeted Value Index. That's a better comparison. And from the looks of it, it's like about 3% higher. 3% in this realm is like kind of large. But what you'll notice is also that they have some crazy, not say crazy, it's higher volatility as well. And so this is something that you need to take note of. Probably not for the faint-hearted. A lot of people like to say that eventually, like, if we focus on the smaller companies that is cheaper, right, you get a lot of companies that is like on the brink of whether they're gonna be bankrupt or not. From this year's, right, you can see that due to the crisis over whether those regional banks are considered the smaller cap banks, and those small cap value, right, they have a very high percentage to financials, which is like about 25 to 26% of the index itself is financial. So if you feel that during that period you struggle with it, right, that then you can understand why that this index, although the returns look so good, right, I'm not sure whether you can tahan this or not. Okay, so we're gonna look at rolling returns, and I think in my first video about crafting the portfolios, right, I showed this one. Basically, let's say we have a whole history of return, probably starting from 1982 to over here. We can take a look at, for a certain period, right, how the returns are. Like, say for example, we want to profile 15 years, we want to see the returns from here to here, and then we move on further here to here. We can roll it year by year or month by month. So in this case, right, you can sometimes you're afraid that maybe you live through a certain 15-year periods where the returns are where returns are just good, and then in another time period the returns for this index might not be so good. So this is what we're gonna profile today to see like how things are. And we're gonna switch over to my spreadsheet over here. This is where the data is. Okay, so what you're seeing over here, right, is a chart of 10-year rolling returns for the four indexes that we mentioned: MSCI World, Dimensional Europe Targeted Value, Dimensional Global Targeted Value, and Dimensional US Targeted Value. And this is 10-year rolling returns, which means that each point over here, right, on this line, right, is a 10-year return. So if we start on Jan 1982, right, that means that it ends in December 1981. Okay, it ends at December 1981. So each point is like about 10-year period. So if you see this numbers over here, 11.3, right, that means that it's a over that 10 years period, the compounded returns for MSCI World, which is this yellow color line, is 11.3%. And what we can see, this is you can see that it's up and down. Basically, if you think that you're gonna earn like a certain return, like let's say 7%, or just now what you see 9.6% returns, it's not always the case. If you're the person over here, you start investing in February 1999, and 10 years later, right, your compounded return is minus 2.5%. That's 10 years. So it's not 9%, it's minus 2.5%. So there is some luck involved one clear thing that you realize is that it's like you wonder whether, like, if you have a better manager, right, would you be able to prevent this 10-year negative 2.5% return? It's a bit challenging. You can see that, like, all of these lines, right, they did during this period. Like, all of these lines, they rise through the periods. That means that your managers can do limited things, but you might have managers that prefers to invest in smaller companies that is cheaper, that has higher profitability, and then they can earn this kind of return. Okay, so you can see that all these three, the US targeted value, global targeted value, and Europe targeted, they all bunch up together. Like during this period when it's doing minus 2.5%, this is probably like the worst period for the US in a long while. They're doing 6.6%. To a lot of people, that's decent returns. Okay, so what your manager is doing, right? Perhaps it's not so much their acumen, but they're just investing in higher risk companies. They are smaller and they are more cheaper. These they tend to be higher risk, and you're compensated for the risk itself. Now, what you'll be able to see is that if the yellow line, right, is the MSCI World, a lot of times, right, in the past, right, the 10-year returns, right, they tend to be better than the MSCI World. There's probably some periods where there is some dislocation. Say, for example, over here, right, the MSCI global, the dimensional global targeted value is doing 6.7%, pretty decent, but the MSCI World is doing 11.3%. So all these kind of like, whether this is better or that is better, right? It's not just a 10-year period thing. If you look across, like all these dots, right? They are all 10-year periods, 10-year rolling returns. Like over here, you can see, if you are investing in, let's say, US targeted value, which is smaller and mid cap companies, that is cheaper, right? You're doing like probably 17% or 16 or 17%. Such a big difference. In Europe, you're doing like something closer to, I think, 8% and all. But generally, there's a lot of stories to tell, because you will consider these are 10-year returns. So there's some crazy thing like, if this is 24%, that is like 24% over a 10-year period. That's kind of crazy. And then this is Europe. This is the one that people now shun, the kind of region people now shun, and then it's doing so crazy. But we can see that recently, like, they all tend to be bunched up together. Not sure whether it's due to like the financialization of all these funds and ETF, that it tends to lead to things like that. But what you'll notice is that Europe is not doing as well. But if you look at these returns, 4.7%, 7.8, 4.7% that is low over here, and these are higher. This line is probably 6%. There's a thing about doing better or doing worse. There's also another thing, is that whether these kind of returns can help you reach your financial goals. And these are 10-year returns. And you can think about, if let's say you can earn 4.7% for a year for 10 years, right? Not the best, but maybe it's better than putting inside cash and then slogging it out. So what we can see is, during this period, the green color is the global targeted value. Like, it's like almost the same performance as the MSCI World over here. Like, most of the comparison that you should focus on is actually like the global and MSCI World. But for my friend over here, right, he's probably looking at the green line and the blue color line. And there's some periods where actually the global targeted value does better. Like over here, they are better. Then there are some periods where I think the US does better. Okay, that's 10 years, right? 40 years, but we're rolling 10 years. what you see over here, right, is probably 15 years, tad longer. So each point on this chart, right, is like about 15 years, and 15 years. So it looks more volatile to a certain extent, but now you also see some crazy things like during these periods, this Europe and probably all this. Okay, this one it makes you clearer that you can see the MSCI World is always the bottom ones, except over here. Then it kind of like, wouldn't say it did better than the global targeted value or the US targeted value, but it definitely does better than the Europe targeted value. But for a long while, you can see that the returns of I think over you can see that US tend to do better than the global. US tend to do better than the global over a 15-year period. Then it starts narrowing. Not too much of difference before this time. US does better, and all. So it becomes the clearest over the 20-year period. Now you can see that these lines that over 20-year periods, US tends to do better than the global. Okay, over a 20-year period. So this might be something that answers his question. We also see that all these small targeted value, they tend to do better than the MSCI World. Small cap and cheaper companies does better than a large cap blend developed index. So we're not sure how it's gonna be like in the future, but the past does show us. It tells us different things. Like over 20, if we talk about a certain tenor where you are able to capture some of the returns, let's say 6% returns, right? I think 20 years is roughly the periods that you need to stay invested. If it's shorter than that, let's say 10 years at 15 years, you can see that sometimes the returns can be lower, like 2.8%, 3.5%. Now you can even invest for 10 years and then it's negative 2.5%. But the interesting thing is, like, if let's say we're not talking about that, we're talking about small cap, right? Like the lowest is like about even Europe by itself. The lowest is 7.4% over 20-year periods. That's pretty good in this regard, and you can see over here, let's say a 15 years period, the lowest probably is over here 4.6%. 4.6. I think it's Europe, 0.7%. This is probably like the worst 15 years period in this 40 years history, and it's recently. The global in terms of global, I think like it's 5.2%. It's pretty decent. And in a way, for this 10 years period, right, probably the lowest is like for Europe is like about 1.1% over here. But one way to look at this is also that one explanation it can be that in the pessimistic scenario, right, you might have a certain return that is similar to large cap blend, which is MSCI World. Okay, of course there's also a possibility over here you do worse lah. You can see this one 11.3%, this is 6.7%. But if you invest in this way, right, there is an opportunity that your returns, you are able to capture that small cap, some profitability, asset omission of that high asset turnover factors. You're able to capture those premium, and your returns will be better. So that's one way of actually interpreting it. So how can you invest in small cap value? I think there are some unit trusts out there that you can invest there. I think okay, dimensional is available in Singapore, and you probably need an advisor to actually get access to it. I think Endawas should be one platform, but not sure whether Endawas they have it. I think by right they they they, they should have it, but someone told me that it's not on FundSmart. So yeah, if it's listed here, I think you should be able to find. So this is the global targeted value that is an implementation of that research index. Which one? Yeah, this global targeted value over here. Do note that this is the actual fund itself. This is a research index. This is not the historical performance. There's a difference between research index and the actual performance. So you can see over here, these are the returns. 3 years 15.15%, 5 years 4.441%. So it's available over here. And of course, not my favorite, but there's a lot of small cap value ETFs that you can buy. They are listed on the US New York Stock Exchange. So famous ones are probably ABUV, Avantis. Avantis is a company where the founders were from Dimensional. That's a long story altogether, which I shall not elaborate. So this is the Avantis small. There's a Avantis small cap value ETF, and I think there is also a dimensional US target value ETF. Yeah, so DFAT. Okay, it's called DFAT. Yeah, sorry, DFAT ETF. Okay. Then there is less choices in that there are UCITS in Europe. If you wish to be more tax efficient, that you don't want to next time suffer from that estate duty kind of considerations, right? You want to use this one, right? There's probably one that is like kind of closer, which is USSC ETF, right? This is State Street's implementation. This is Spider MSCI USA small cap value weighted UCITS ETF. This is not exactly like picking the cheapest company, but they're more like tilting means that they tilt towards the cheapest companies in the small cap universe. You can see that I think there's like about 1,833 holdings. Then the average P ratio is about 10.6 times. You can look at each. The market cap is quite big. It's like about, on average, it's like about 4 billion. And so you can see the performance over here. I think it's pretty decent. If we talk about annualized, 5 years is like about 8.6%. 3 years is about 24%. So those are some place where if you have a broker like Interactive Brokers, DBS Vickers, Standard Chartered, or Saxo, you can invest on these funds on the London Stock Exchange. With that, I think I come to the end of my video. If you have any questions, do leave in the comments. As always, this is more for entertainment purpose. I'm not asking you to invest in any of these funds or ETFs. Do your own research. I bear no responsibility if you lose money or this ends up like very unsuitable for you. Okay, with that, I'll see you in the next video.